Between 1914 and 1918, the global banking system performed the most extraordinary feat in financial history. It created over $200 billion out of thin air to fund the First Industrial War, transforming banks from conservative institutions that lent existing deposits into money creation machines that financed unprecedented government spending through pure monetary expansion. This wasn't just about war bonds or patriotic lending. It was a complete transformation of how money worked. Before 1914, banks operated under gold standard constraints that limited their ability to create credit. But the demands of total war shattered these ancient limitations, forcing banks to develop revolutionary financing techniques that would reshape capitalism forever. The numbers are staggering. Britain alone borrowed over £6 billion during the war, more than the entire British national output before 1914. Germany created 60 billion marks through various financial mechanisms. The United States, which entered the war with virtually no federal debt, emerged with obligations exceeding $25 billion. France, Russia, Austria-Hungary, every major power financed military operations through monetary expansion that dwarfed anything previously attempted. But what most people don't understand is how this financial revolution worked behind the scenes. Central banks abandoned gold convertibility while creating money to purchase government bonds. Commercial banks developed syndicate lending on unprecedented scales. Investment banks pioneered mass marketing of government securities to ordinary citizens. Shadow banking systems emerged to handle transactions too large and complex for traditional institutions. The secret history of war finance reveals how bankers, central bank governors, and treasury officials collaborated to create the modern financial system we live with today. Every major innovation in 20th century banking, from central bank money creation to mass retail securities markets, was pioneered during World War I, out of desperate necessity to fund military operations that consumed resources at rates no peacetime economy had ever experienced. This is the story of how 4 years of industrial warfare transformed banking from a conservative profession into the engine of perpetual monetary expansion, creating both the techniques and institutions that would finance every subsequent government expansion, economic crisis, and military conflict for the next century. The transformation of global banking systems between 1914 and 1918 represents one of the most dramatic institutional changes in economic history, as the financial constraints and conservative practices that had governed international finance for centuries were abandoned in favor of unprecedented monetary expansion and government financial intervention that would reshape the global economy permanently. Before World War I, international banking operated according to principles that had evolved over hundreds of years of commercial development. Banks were primarily intermediaries that lent depositors' savings to borrowers, while governments financed extraordinary expenses through taxation or borrowing from existing wealth holders. Central banks, where they existed, served mainly to maintain gold convertibility and provide emergency liquidity during financial panics, rather than actively managing economic conditions. The gold standard imposed automatic constraints on both government spending and bank credit creation, as any excessive monetary expansion would trigger gold outflows that forced immediate policy reversal. This system had maintained remarkable price stability and currency predictability throughout the 19th century, while enabling the first truly global economy through standardized monetary relationship and automatic balance of payments adjustment mechanisms. Commercial banking relationships were based on personal knowledge and local connections, with most banks serving regional markets and maintaining conservative lending standards that reflected the limited depositor funds available for loan expansion. International banking was dominated by a small number of prestigious houses that specialized in trade finance and government bond distribution, operating through networks of personal relationships and correspondent banking arrangements. Government finance followed predictable patterns established over centuries of experience, with peacetime budgets balanced through taxation, while extraordinary expenses like wars were funded through borrowing from wealthy individuals and institutional investors. The scale of government borrowing was constrained by the available private wealth that could be mobilized for public purposes, while debt service requirements were limited by government's ability to raise taxes without triggering economic disruption or political opposition. The outbreak of war in August 1914 immediately shattered these traditional financial arrangements, as military expenditures exceeded any possible level of taxation or conventional borrowing, while the scale and duration of combat operations required financial resources that no existing institutional arrangements could provide. Traditional banking and government finance proved completely inadequate for supporting industrial warfare that consumed materials, equipment, and human resources at unprecedented rates. Military spending requirements dwarfed all previous government expenditures, with major powers spending 10–20 times their pre-war budgets while maintaining these levels for years rather than months. The British government's daily spending increased from about £500,000 in peacetime to over £5 million during active warfare. German military expenditures rose from 2 billion marks annually before the war to over 15 billion marks in 1917. Similar patterns characterized every major belligerent power. The inadequacy of traditional financing methods became apparent within months of the war's beginning, as attempts to fund military operations through conventional taxation and bond sales to existing wealth holders proved insufficient for the scale of resources that modern warfare required. New financial techniques and institutional arrangements were necessary to mobilize the economic resources that total war demanded. Central bank policy underwent revolutionary transformation as monetary authorities abandoned gold standard constraints in favor of currency and credit expansion designed to support government, borrowing and economic mobilization. The Bank of England, which had maintained gold convertibility for over 200 years, suspended convertibility within days of war's outbreak. Similar decisions by other central banks marked the end of the international monetary system that had governed global finance since the 19th century. Commercial banking practices evolved to accommodate government financing needs that exceeded all previous experience, as banks developed syndicate lending arrangements, purchased government securities with newly created deposits, and participated in mass marketing campaigns that transformed government bond ownership from an elite preserve to a popular investment instrument. The financial innovations developed during World War I established precedents and institutional capabilities that would influence government finance and monetary policy for the rest of the 20th century. The techniques of central bank money creation, mass government borrowing, and financial market manipulation that were pioneered during the war provided tools that governments would continue using for economic management long after the military emergency had passed. International financial relationships were permanently altered as the war's financing requirements created creditor-debtor relationships between former allies, while destroying the currency stability and automatic adjustment mechanisms that had enabled the pre-war global economy. The United States emerged from the war as the world's dominant creditor, while European powers faced debt burdens that would constrain their economic and political development for decades. To understand how modern government finance and monetary systems developed, we need to examine the specific innovations and institutional changes that war financing requirements forced upon banking systems that had previously operated according to fundamentally different principles and constraints. German system. Germany's financial mobilization for World War I demonstrated both the strengths and vulnerabilities of the continental European banking model, as the universal banking system and state-directed economic policies that had supported rapid industrial development proved capable of extraordinary wartime resource mobilization, while creating inflationary pressures that would ultimately undermine currency stability and economic effectiveness. The German financial system's initial response to war mobilization revealed sophisticated institutional capabilities that had been developed through decades of state-supported industrialization, military preparation. The Reichsbank's substantial gold reserves and conservative monetary policies had created a foundation for currency stability that initially enabled Germany to finance military operations without immediate financial disruption. Universal banking arrangements that characterized German finance provided unique advantages for war mobilization, as institutions like Deutsche Bank and Dresdner Bank combined commercial banking, investment banking, and industrial finance within integrated organizations that could rapidly redirect resources toward military production. These comprehensive relationships enabled coordinated mobilization of financial and industrial resources that more specialized banking systems could not match. The Reichsbank's transformation from conservative central bank to active financier of government operations represented one of the war's most dramatic institutional changes, as bank officials abandoned gold standard constraints in favor of unlimited currency creation designed to support military spending. This transformation occurred gradually through a series of policy changes that maintained the appearance of fiscal responsibility while actually enabling unlimited government borrowing. Government borrowing techniques developed by German financial authorities included innovations in bond marketing, institutional sales, and public financial education that mobilized savings from previously untapped sources while maintaining public confidence in government financial management. The successful sale of war loans to ordinary citizens demonstrated how patriotic appeals could overcome traditional German saving preferences for bank deposits and real estate. Industrial finance arrangements that connected banks directly with manufacturing enterprises enabled rapid conversion of civilian production to military purposes while maintaining the capital, investment and technological development that war production required. These relationships provided models for state-directed economic development that would influence German economic policy throughout the 20th century. Currency management policies that maintained the mark's international acceptability despite abandoning gold convertibility required sophisticated diplomatic and financial arrangements with neutral countries and trading partners. German financial authorities developed techniques for supporting exchange rates through trade policy, bilateral agreements, and currency manipulation that pioneered modern exchange rate management practices. The development of shadow banking arrangements to handle transactions too large or complex for traditional institutions included the creation of special-purpose vehicles for government borrowing, industrial finance, and international trade that operated outside normal regulatory oversight while enabling flexibility and secrecy that military and economic planning required. Regional banking coordination throughout the German Empire required integrating the financial systems of constituent states while maintaining local institutional autonomy and political relationships. This coordination demonstrated how federal financial arrangements could support centralized military planning while preserving regional economic and political structures. International trade finance arrangements that maintained German commercial relationships despite military conflict required developing alternative payment systems, currency arrangements, and credit facilities that enabled continued commerce with neutral countries while financing essential imports of raw materials and food products. Inflation management became increasingly challenging as unlimited government borrowing created monetary expansion that threatened to undermine currency stability and economic planning. German financial authorities developed sophisticated techniques for managing price expectations and controlling visible inflation, while enabling continued monetary expansion to support military operations. Banking regulation expanded dramatically as government authorities assumed direct control over credit allocation, foreign exchange operations, and securities markets that had previously operated according to market principles. These regulatory innovations established precedents for comprehensive government oversight of financial operations, while demonstrating how crisis conditions could justify unprecedented expansion of state economic authority. Corporate finance arrangements that supported war production included government equity participation, guaranteed loans, and directed investment policies that created new relationships between state and private enterprise. These arrangements established models for mixed economy structures that would influence German economic organization long after the war ended. Resource mobilization through financial mechanisms included techniques for converting private savings into government spending while maintaining incentives for continued work and production. The development of forced saving programs and consumption controls demonstrated how financial policies could support total war mobilization while attempting to maintain domestic economic stability. Labor finance arrangements, including wage controls, savings programs, and social welfare policies, demonstrated how financial institutions could support comprehensive economic mobilization while maintaining worker cooperation and social stability. These programs established precedents for welfare state development, while showing how financial mechanisms could serve broader social and political objectives. Technology development financing through government and banking partnerships enabled continued innovation and production improvement, despite resource constraints and military priorities. These arrangements demonstrated how financial institutions could support technological progress during crisis conditions while maintaining long-term economic development capabilities. International financial warfare tactics, including currency manipulation, trade disruption, and credit restrictions, demonstrated how financial capabilities could serve military objectives while creating economic pressure on enemy powers. These techniques established precedents for economic warfare that would become standard practices during subsequent international conflicts. Provincial banking systems throughout Germany demonstrated remarkable adaptability and coordination during wartime mobilization, as regional institutions maintained local services while contributing to national financial objectives. This coordination demonstrated the effectiveness of decentralized banking systems for supporting comprehensive economic mobilization while preserving local economic relationships. The strain of unlimited financial expansion began manifesting in currency depreciation and commodity shortages by 1916, as the conflict between unlimited government spending and limited real resources created inflationary pressures that German financial authorities struggled to control through administrative measures and public communication rather than fiscal discipline. By 1918, German government debt had reached levels that exceeded the economy's ability to service through normal taxation, while currency depreciation was accelerating despite official controls and propaganda. The financial system's remarkable mobilization capabilities had enabled unprecedented military efforts while creating the monetary instability that would contribute to post-war economic and political crisis. Pre-war banking. The international banking system that existed in 1914 represented the culmination of centuries of financial evolution, characterized by institutional conservatism, gold standard discipline, and limited government involvement that would prove completely inadequate for the financial demands that industrial warfare would impose upon the global economy. The Bank of England stood at the center of this system as the world's premier financial institution, operating according to principles established by centuries of experience with maintaining gold convertibility, while providing the international leadership that enabled the classical gold standard to function effectively. The bank's gold reserves, typically maintained at 30 to 40% of note circulation, provided the foundation for international confidence in sterling, while enabling London to serve as the world's financial capital. British commercial banks operated through a sophisticated network of institutions that had evolved to serve the needs of international trade and imperial finance. The Big Five clearing banks, Lloyds, Barclays, Midland, Westminster, and National Provincial, dominated domestic banking while maintaining extensive overseas operations. These institutions combined retail banking services for domestic customers with merchant banking capabilities for international finance and trade credit. Merchant banking houses including Rothschild, Baring Brothers, and Hambros specialized in international finance, government bond underwriting, and trade financing that connected British capital markets with investment opportunities throughout the world. These prestigious firms operated through personal relationships and family networks that had been developed over generations of international commercial activity. The London money market provided sophisticated mechanisms for short-term finance and international arbitrage that enabled efficient capital allocation while maintaining the currency stability and interest rate relationships that gold standard operations required. The discount market, bill broking and acceptance credit systems provided financing for international trade while enabling banks to manage liquidity and maintain profitability. German banking had developed along different organizational lines, featuring universal banks that combined commercial banking, investment banking, and industrial finance within single institutions. The Deutsche Bank, Dresdner Bank, and other major institutions maintained close relationships with industrial enterprises while providing comprehensive financial services that supported Germany's rapid industrial development during the late 19th century. The Reichsbank served as Germany's central bank, while maintaining gold convertibility and managing the monetary policy that had enabled Germany's emergence as Europe's dominant industrial power. The bank's sophisticated understanding of international finance and industrial credit requirements provided the foundation for Germany's challenge to British financial dominance. French banking centered on the Banque de France, and a network of commercial banks that had provided the financial foundation for France's colonial empire and industrial development. The bank's substantial gold reserves and conservative monetary policies had maintained franc stability while enabling French investors to finance industrial development throughout Europe and the French colonial empire. Crédit Lyonnais, Société Générale, and other major French banks had developed extensive international operations while specializing in government bond distribution and international lending that made Paris a major European financial center. French banks had particular expertise in Eastern European and Russian finance that would prove important during the coming conflict. American banking remained fragmented and regionally organized, lacking the central banking institution and international sophistication that characterized European financial centers. The absence of a central bank created periodic financial instability while limiting American banks' ability to compete with European institutions in international finance and government lending. However, American financial resources were growing rapidly as industrial development and population growth created enormous capital accumulation that was beginning to seek international investment opportunities. Wall Street firms including J.P. Morgan and Company had developed capabilities for large-scale industrial finance and international lending that would prove crucial during the coming war. Russian banking combined state-dominated institutions with private banks that had financed industrial development and railway construction with substantial foreign investment. The State Bank of the Russian Empire maintained substantial gold reserves while managing the monetary policy that had enabled Russia's rapid economic growth during the early 20th century. Austrian and Hungarian banks served the diverse financial needs of the Habsburg Empire's multinational economy while maintaining the currency stability that enabled the empire to participate in international commerce and capital markets. The Austro-Hungarian Bank managed monetary policy for one of Europe's largest and most complex economies. International banking relationships operated through correspondent arrangements and personal networks that enabled cooperation and competition while maintaining the stability and predictability that gold standard operations required. These relationships provided the mechanisms for international payments, currency exchange, and capital movements that supported the integrated global economy. Banking regulation remained minimal in most countries, with institutions operating according to traditional practices and competitive pressures rather than detailed government oversight. This regulatory environment reflected confidence in market discipline and conservative banking practices that had maintained stability while enabling economic growth and financial development. Capital adequacy standards were maintained through conservative practices and market discipline rather than formal regulatory requirements, as banks recognized that excessive risk-taking could threaten their survival, while depositor confidence depended on perceived financial strength and operational competence. International capital movements flowed freely under gold standard arrangements that eliminated currency risks while enabling efficient allocation of investment capital to its most productive uses. These capital flows supported economic development throughout the world, while creating the integrated financial relationships that would transmit both prosperity and instability across national boundaries. Credit creation remained constrained by gold standard requirements and conservative banking practices that limited monetary expansion to levels consistent with maintaining currency, convertibility, and depositor confidence. These constraints had prevented the excessive credit expansion and inflation that would characterize later periods of unconstrained monetary policy. The sophistication and conservative principles that characterized pre-war banking systems represented centuries of institutional evolution and practical experience, but these systems were designed for peacetime economic relationships and government financial needs that bore no resemblance to the requirements that industrial warfare would impose upon financial institutions and monetary authorities. By August 1914, the international banking system had achieved remarkable stability and effectiveness in supporting global commerce and economic development, but these achievements were built on foundations that would crumble when subjected to the unprecedented pressures of financing total war between the world's major industrial powers. War declarations. The outbreak of World War I in August 1914 triggered immediate financial panic that threatened to destroy the international banking system within days, as investors frantically attempted to convert securities and foreign currencies into gold, while credit markets froze and stock exchanges closed to prevent complete collapse of the international financial order. The assassination of Archduke Franz Ferdinand on June 28, 1914, initially caused only modest financial market disruption, as investors had become accustomed to periodic political crises in the Balkans that typically resolved without major military conflict. However, the diplomatic crisis that developed during July created increasing anxiety in financial markets as the possibility of general European war became apparent. Austrian financial markets experienced the first severe disruption as the Habsburg government's ultimatum to Serbia triggered capital flight and currency speculation that forced the Austro-Hungarian bank to implement emergency measures to maintain exchange rate stability. The Vienna Stock Exchange closed on July 27th, as massive selling pressure threatened to create panic conditions that could spread throughout European financial markets. The London financial market, despite its sophistication and international leadership, proved vulnerable to the panic that began developing as European diplomatic relations deteriorated. Foreign investors began liquidating British securities while demanding conversion to gold, creating unprecedented pressure on the Bank of England's reserves. The London Stock Exchange experienced massive selling pressure that threatened to overwhelm the market-making capabilities of traditional market participants. German financial markets reflected the economy's preparation for possible military action, as the Reichsbank began accumulating gold reserves while commercial banks restricted lending to preserve liquidity for unknown future requirements. The Berlin Stock Exchange experienced significant selling pressure from foreign investors, while domestic confidence remained relatively stable due to public faith in German military preparedness. French financial markets were disrupted by massive capital flight, as investors anticipated that France would be involved in any general European conflict. The Banque de France faced substantial gold outflows, while commercial banks experienced deposit withdrawals that threatened to create liquidity crises. The Paris Stock Exchange was forced to implement emergency measures to maintain orderly trading conditions. Russian financial markets collapsed almost immediately, as investors recognized that Russian military mobilization would require enormous financial resources that the empire's limited fiscal capabilities could not provide through conventional means. The Russian state bank faced massive gold outflows while commercial banks suspended normal lending operations to preserve cash for emergency requirements. The international foreign exchange market, which had operated with remarkable stability under gold standard arrangements, experienced unprecedented volatility as investors attempted to convert vulnerable currencies into gold or the currencies of countries that seemed likely to remain neutral. Traditional arbitrage relationships broke down as market participants focused on capital preservation rather than profit opportunities. New York financial markets initially benefited from European disruption as American investors repatriated funds, while foreign investors sought safe havens for capital flight from European markets. However, American markets also experienced significant disruption as international payment systems broke down and credit relationships with European counterparts became uncertain. The London money market, which served as the center of international short-term finance, experienced complete breakdown as international credit lines were suspended while banks and discount houses faced massive demands for cash that exceeded their normal operational capabilities. Traditional lending relationships broke down as counterparty risk became impossible to evaluate under rapidly changing conditions. International payment systems experienced severe disruption as banks restricted foreign exchange operations while exchange rates deviated from gold standard parities due to massive speculative flows. Letters of credit and other trade finance instruments became difficult to execute as banks questioned the creditworthiness of foreign counterparts and the stability of international monetary arrangements. Central bank cooperation, which had maintained international financial stability through informal networks and coordinated policies, broke down as national monetary authorities faced domestic pressures that took precedence over international coordination. The collaborative relationships that had supported gold standard operations were replaced by competitive policies designed to protect national financial systems. Commercial bank lending contracted sharply as institutions faced massive deposit withdrawals while being unable to evaluate credit risks under rapidly changing economic and political conditions. Banks throughout Europe suspended normal lending operations while focusing on maintaining liquidity and preserving capital for unknown future requirements. Government bond markets experienced massive disruption as investors demanded higher yields to compensate for increased political and currency risks, while governments faced the prospect of financing military operations that would far exceed normal budgetary resources. Traditional government borrowing mechanisms proved inadequate for the financial requirements that general war would create. Insurance markets faced unprecedented challenges as war risk exclusions in existing policies created disputes about coverage, while new insurance became either unavailable or prohibitively expensive. Marine insurance markets in particular faced the prospect of massive claims from military action against commercial shipping while being unable to assess risks or set appropriate premiums. The suspension of gold convertibility by major central banks marked the end of the international monetary system that had provided stability and predictability for decades, while creating uncertainty about future exchange rate relationships and international payment mechanisms. These suspensions, initially presented as temporary wartime measures, represented fundamental changes in monetary arrangements that would prove permanent. Emergency measures implemented by stock exchanges throughout Europe, including trading suspensions and price limits, demonstrated the inadequacy of normal market mechanisms for handling the panic conditions that war fears had created. These measures prevented immediate collapse while highlighting the vulnerability of financial markets to political and military developments. Banking syndicates and cooperative arrangements that had been developed for normal commercial purposes proved inadequate for managing the crisis conditions that war preparation had created, as traditional risk-sharing mechanisms broke down when all participants faced similar pressures simultaneously. By early August 1914, it had become clear that the international financial system was completely unprepared for the requirements of modern warfare, while traditional banking arrangements would need to be supplemented or replaced by new institutional mechanisms capable of mobilizing the enormous financial resources that industrial war would require. The financial panic that accompanied war declarations provided the first indication that the conservative banking practices and limited government financial involvement that had characterized the pre-war system would prove inadequate for the challenges ahead, setting the stage for the revolutionary changes in financial institutions and practices that the war would force upon the global economy. British finance, Britain's financial mobilization for World War I, represented the most comprehensive transformation of government finance in the nation's history, as the Treasury and Bank of England abandoned centuries of conservative fiscal and monetary policy in favor of revolutionary techniques that would enable unprecedented government spending, while fundamentally altering the relationship between the state and the financial system. The immediate crisis that confronted British financial authorities in August 1914 reflected the complete inadequacy of traditional government finance for supporting modern industrial warfare. Britain's pre-war annual government expenditure had been approximately £200 million, while military experts estimated that effective participation in a European war would require spending of at least £500 million annually, with actual requirements proving far higher as the conflict intensified. Chancellor of the Exchequer, David Lloyd George's initial response to the financial crisis demonstrated both innovation and adherence to traditional principles, as he attempted to finance increased military spending through higher taxation while maintaining fiscal responsibility. The emergency budget of November 1914 doubled income tax rates while introducing new taxes on excess profits and luxury consumption, but these measures provided only a fraction of the revenues that military operations required. The Treasury's development of comprehensive government borrowing programs represented a fundamental departure from British financial traditions, as officials designed mass marketing campaigns to sell government bonds to ordinary citizens, rather than relying on traditional sales to wealthy investors and institutions. The introduction of war loans and victory bonds transformed government borrowing from an elite financial activity into a popular patriotic duty. The Bank of England's abandonment of gold standard constraints marked the end of the monetary system that had made London the world's financial capital, as Governor Montague Norman and his colleague chose to support government borrowing requirements rather than maintain the currency convertibility that had been the foundation of British financial leadership. This decision enabled unlimited expansion of bank credit and government borrowing, while destroying the automatic fiscal discipline that gold convertibility had provided. Commercial banks' participation in government finance required fundamental changes in banking practices, as institutions that had specialized in short-term commercial lending became primary dealers in long-term government securities while developing new techniques for managing interest rate and credit risks. The Big Five clearing banks became government bond distribution networks while maintaining their traditional commercial banking operations. The development of the National War Bonds program demonstrated how financial innovation could mobilize resources from previously untapped sources, as marketing campaigns encouraged ordinary citizens to purchase government securities through installment plans and small denomination bonds that made government finance accessible to middle-class and working-class investors for the first time. Government control over financial markets expanded dramatically as authorities implemented controls over foreign exchange, restricted capital movements, and directed bank lending toward government and essential civilian purposes. These controls represented unprecedented peacetime intervention in financial markets while establishing precedents for government economic management that would persist long after the war ended. The creation of new government institutions, including the Ministry of Munitions and various wartime agencies, required financing mechanisms that went beyond traditional budgetary processes, as these agencies developed independent borrowing capabilities and financial arrangements that circumvented normal Treasury oversight while enabling rapid resource mobilization. Currency management became increasingly sophisticated as the Treasury and Bank of England developed techniques for managing exchange rates without gold backing, while maintaining international confidence in sterling through diplomatic and financial arrangements with allies and neutral countries. These techniques pioneered modern foreign exchange intervention and currency management policies. The mobilization of imperial financial resources required developing new mechanisms for coordinating monetary and fiscal policies across the British Empire, as colonial governments contributed to war finance while maintaining their own financial stability. The sterling area that emerged from these arrangements provided a model for post-war international monetary cooperation while demonstrating how currency arrangements could serve political as well as economic purposes. Industrial finance arrangements developed during the war created new relationships between government and private industry, as official agencies provided direct financing for war production while taking ownership stakes in essential industries. These arrangements pioneered the government-industry partnerships that would characterize British economic policy throughout the 20th century. Banking concentration accelerated during the war, as smaller institutions were absorbed by larger banks that possessed the capital and operational capabilities necessary for government finance, wartime lending. This consolidation created the concentrated banking structure that would dominate British finance for decades, while eliminating many regional and specialized institutions. International lending arrangements required developing new diplomatic and financial relationships with allies, as Britain provided substantial loans to France, Russia, and other partners while coordinating policies to maintain exchange rate stability and payment system effectiveness. These arrangements established precedents for international economic cooperation while creating the inter-allied debt relationships that would complicate post-war financial reconstruction. The expansion of financial regulation during wartime included controls over securities markets, banking operations, and international capital flows that represented fundamental departures from the liberal economic policies that had characterized pre-war Britain. These regulatory innovations established institutional capabilities for economic management that would be expanded and refined during subsequent decades. Monetary policy innovations included techniques for managing interest rates, controlling credit expansion, and coordinating policies with fiscal authorities that went far beyond the Bank of England's traditional role as guardian of gold reserves and lender of last resort. These innovations established central banking practices that would become standard tools for economic management throughout the developed world. The development of government debt markets required creating new instruments, marketing techniques, and institutional arrangements that could mobilize savings from previously untapped sources while managing the enormous scale of borrowing that wartime finance required. These innovations transformed government bond markets from specialized institutional preserve to mass retail markets that enabled democratic participation in government finance. Public finance administration underwent revolutionary changes as the Treasury developed new organizational capabilities for managing unprecedented spending levels while maintaining accountability and efficiency. These administrative innovations established the institutional foundations for modern government financial management, while demonstrating how bureaucratic capabilities could be rapidly scammed during crisis conditions. By 1918, British government annual spending had reached over £2.5 billion, more than 10 times pre-war levels, while national debt had increased from £650 million to over £7 billion. These unprecedented fiscal changes had been accomplished through financial innovations that permanently altered British monetary and fiscal institutions while establishing techniques that would influence government economic policy throughout the world. American neutrality. American financial institutions during the neutrality period, 1914 to 1917, experienced unprecedented growth and international influence as European war demands created enormous opportunities for trade finance, industrial lending, and securities underwriting, while transforming the United States from a debtor nation into the world's primary source of international capital and financial services. The initial American response to European financial crisis demonstrated both opportunity and caution, as Wall Street firms recognized the potential profits available from war financing while maintaining traditional reluctance to become involved in European political conflicts. Major investment banks including J.P. Morgan and Company began exploring opportunities to finance Allied purchases of American goods while avoiding direct involvement in military operations. Federal Reserve System operations during the neutrality period provided crucial stability and institutional support for American financial expansion, as the newly created central bank demonstrated its capability for managing domestic monetary conditions while supporting the international financial operations that were transforming America's role in the global economy. The Fed's sophisticated understanding of international finance proved essential for managing the capital flows and currency pressures that war-related business created. Commercial banking expansion reflected the enormous increase in international trade and finance business that European war demands generated, as American banks developed new capabilities for trade finance, foreign exchange operations, and international lending while maintaining traditional domestic commercial banking services. Regional banks throughout the country experienced growth as war-related economic activity stimulated business lending and deposit growth. Securities markets development included both government and corporate bond financing that reached unprecedented scales as American corporations expanded production capacity while European governments sought financing for military purchases. The New York Stock Exchange became increasingly important for international capital raising while developing new techniques for marketing securities to institutional and individual investors. Trade finance arrangements that supported massive increases in American exports to Europe required developing new techniques for managing payment risks, currency fluctuations, and transportation difficulties while maintaining the credit facilities that enabled continued commercial relationships despite military disruptions to normal international commerce. Industrial finance expansion reflected the rapid growth of American manufacturing capacity as companies expanded production to meet European demand for military equipment, raw materials, and manufactured goods. Banks developed new approaches to industrial lending while supporting the technological innovation and capacity expansion that war demand stimulated. Agricultural finance arrangements supported dramatic increases in American farm production as European agricultural output declined, while demand for food products increased. Rural banks and agricultural credit cooperatives expanded lending while developing new techniques for managing commodity price risks and seasonal financing requirements. International lending operations that began during the neutrality period established the foundation for America's emergence as the world's dominant creditor, as American banks and investors provided financing for allied governments and businesses while developing the institutional capabilities that would enable continued international financial leadership after the war. J.P. Morgan and Company's role as allied purchasing agent in the United States demonstrated how private financial institutions could serve quasi-governmental functions while generating enormous profits from war-related business. The Morgan firm's coordination of allied purchases, financing arrangements, and shipping logistics established precedents for investment banking involvement in government operations. Government policy toward war finance during the neutrality period reflected tensions between official neutrality and economic opportunities, as the Wilson administration attempted to maintain political neutrality while allowing American businesses and banks to profit from European war demands. These policies required careful legal and diplomatic management to avoid compromising American neutrality while enabling economic benefits. Currency and exchange rate management became increasingly important as war-related capital flows created pressures on the dollar, while European currency instability affected American international business. The Federal Reserve developed techniques for managing these pressures while supporting American financial institutions' international operations. Regional financial development throughout the United States reflected the broad distribution of war-related economic benefits, as agricultural regions experienced commodity price increases, while industrial areas benefited from expanded manufacturing demand. This geographic distribution of benefits created political support for continued American involvement in war-related business. Investment banking innovation included new techniques for underwriting and marketing securities while managing the risks associated with war-related investments. American investment banks developed capabilities for large-scale securities distribution while pioneering mass marketing techniques that would transform American capital markets. Banking regulation during the neutrality period remained limited despite the rapid growth and international expansion of American financial institutions, as traditional American preferences for minimal government oversight continued, while the Federal Reserve focused on monetary stability rather than comprehensive financial regulation. International banking relationships that American institutions developed during the neutrality period included correspondent banking arrangements, foreign exchange operations, and lending syndications that established permanent connections between American and European financial markets, while creating institutional capabilities for continued international financial operations. Corporate finance arrangements that supported American industrial expansion included both debt and equity financing, while enabling companies to take advantage of war-related demand increases. These arrangements established precedents for large-scale corporate finance, while demonstrating how financial markets could support rapid industrial development. Labor finance and social welfare arrangements that accompanied American economic expansion included industrial banking, payroll savings programs, and employee lending that demonstrated how financial institutions could support social stability while profiting from economic growth. These programs established models for employer-sponsored financial services, technology finance and innovation funding that supported American industrial and agricultural development, included lending for new equipment, research and development financing, and venture capital for new enterprises. These arrangements demonstrated how financial institutions could support technological progress while generating profits from innovation. Insurance market development that accompanied American economic expansion included new products for international trade, industrial operations, and personal financial security that reflected the changing nature of American economic relationships. Insurance companies developed international capabilities while expanding domestic market coverage. By early 1917, American financial institutions had been transformed by 3 years of war-related business growth, developing international capabilities and institutional sophistication that would enable effective support for American military participation while maintaining the domestic financial stability that rapid economic expansion required. French innovation. France's financial mobilization demonstrated remarkable institutional innovation and adaptation as the nation's banking system, faced with unprecedented military spending requirements and the physical destruction of significant industrial and agricultural areas, developed revolutionary financing techniques that would influence government finance throughout the developed world for generations. The Banque de France's transformation from conservative central bank to active government financier required fundamental changes in monetary policy and institutional relationships that reflected both the desperate circumstances of French military defense and the sophisticated understanding of modern finance that French monetary authorities possessed. Governor Georges Palin's policies abandoned traditional gold standard constraints while maintaining international confidence in the franc through diplomatic coordination and innovative exchange rate management. Commercial banking adaptation to wartime requirements included the development of syndicate lending arrangements for government bond distribution that mobilized savings from previously untapped sources while maintaining traditional banking relationships and services. The Crédit Lyonnais, Société Générale, and other major institutions pioneered techniques for mass marketing of government securities while expanding their branch networks to reach rural areas and smaller cities. Government borrowing innovations included the creation of new financial instruments and marketing techniques that appealed to patriotic sentiments while providing attractive investment returns for ordinary citizens. The development of defense bonds and victory loans transformed government finance from an elite activity into popular participation that democratized investment while generating enormous amounts of capital for military operations. Regional banking coordination throughout France required maintaining financial services in areas threatened by military action while redirecting resources toward government finance and essential civilian activities. Provincial banks demonstrated remarkable adaptability and patriotic cooperation while maintaining local economic relationships that supported community stability during crisis conditions. International financial relationships that France maintained during the war included complex arrangements with Britain, the United States, and other allies that provided essential foreign exchange and import financing while creating inter-allied debt relationships that would influence post-war international financial reconstruction. These arrangements demonstrated how financial cooperation could support military alliance relationships. Industrial finance arrangements that supported rapid conversion of civilian production to military purposes required new relationships between banks and manufacturing enterprises, while enabling continued technological development and production efficiency improvement. French banks developed expertise in industrial project finance while supporting small and medium enterprises that contributed to war production. Agricultural finance arrangements that maintained food production despite military mobilization and territorial occupation required innovative lending techniques and government support programs that kept rural communities functioning while providing urban areas with essential food supplies. Rural credit cooperatives expanded their operations while adapting to wartime conditions. Currency management policies that maintained franc stability despite massive government borrowing and monetary expansion required sophisticated international coordination and domestic financial management that preserved public confidence while enabling unlimited government spending. These policies pioneered modern techniques for managing exchange rates without gold backing. Shadow banking systems that developed to handle transactions too sensitive or complex for traditional institutions included special-purpose vehicles for government finance, international trade, and industrial mobilization that operated with government support while maintaining operational secrecy. These arrangements established precedents for off-balance sheet financing and complex structured transactions. Social welfare finance that maintained public support for continued military effort included family allowances, pension programs, and employment assistance that demonstrated how financial mechanisms could serve social policy objectives while maintaining economic stability. These programs established foundations for the comprehensive welfare state that would characterize post-war France. Securities market development that supported massive government borrowing required creating new trading mechanisms, clearing systems, and investor services that could handle unprecedented transaction volumes while maintaining market stability and investor confidence. The Paris Bourse adapted its operations while developing new techniques for government bond distribution and trading. Insurance market adaptation that addressed war-related risks and social needs included new products for military families, industrial operations, and international trade that demonstrated how insurance could serve both private and public policy objectives. French insurance companies expanded their operations while developing expertise in managing unprecedented risks. Technology finance arrangements that maintained French industrial competitiveness despite resource constraints and military priorities included government-supported research and development programs that kept French enterprises at the forefront of industrial innovation. These arrangements established models for government support of technological development. International trade finance arrangements that maintained French commercial relationships despite military conflict required developing alternative payment systems and credit facilities that enabled continued commerce with neutral countries while financing essential imports. French banks pioneered techniques for trade finance under extreme conditions. Labor finance programs that maintained worker productivity and social stability included payroll savings programs, housing finance, and consumption subsidies that demonstrated how financial mechanisms could support comprehensive social mobilization while maintaining economic incentives for continued work and production. Corporate finance innovations that supported business adaptation to wartime conditions included government loan guarantees, directed investment programs, and tax incentives that maintained private enterprise capabilities while ensuring that business activities supported national objectives. These arrangements established precedents for mixed economy structures. Resource mobilization techniques that converted private wealth into public resources included taxation innovation, forced savings programs, and asset requisition procedures that maintained property rights while ensuring that national resources were available for military purposes. These techniques influenced tax policy and government finance throughout the developed world. Banking regulation expansion that provided government oversight of financial operations included controls over credit allocation, foreign exchange transactions, and securities trading that demonstrated how emergency conditions could justify comprehensive government involvement in previously private financial relationships. By 1918, French financial institutions had demonstrated remarkable innovation and adaptability while providing the foundation for military survival and eventual victory. The techniques developed during the war established precedents for government economic management that would influence French economic policy throughout the 20th century, while contributing to innovations that became standard practices in modern government finance. Russian collapse. The Russian financial system's catastrophic breakdown during World War I provided the most dramatic example of how traditional banking institutions could completely collapse under the pressures of modern warfare, creating economic chaos that contributed directly to revolutionary upheaval and the destruction of the Tsarist political system. The Russian state bank's initial position appeared stronger than many European central banks, with substantial gold reserves and conservative monetary policies that had supported currency stability and economic growth during the pre-war period. However, the scale of resources required for Russian military mobilization quickly overwhelmed the financial system's capacity while revealing fundamental structural weaknesses in Russian economic and political institutions. Government borrowing requirements that exceeded 15 billion rubles during the war period represented more than triple Russia's entire pre-war national income, creating financial demands that no existing institutional arrangements could support through conventional means. The Russian government's attempts to finance these requirements through foreign borrowing, domestic bond sales, and monetary expansion all proved inadequate, while creating cumulative pressures that destroyed confidence in Russian financial institutions. Commercial banking operations throughout the Russian Empire experienced severe disruption as military mobilization and economic chaos created massive deposit withdrawals, while traditional lending relationships broke down. Regional banks that had supported agricultural and commercial development proved unable to adapt to wartime conditions while maintaining basic financial services for their communities. Currency creation by the state bank reached unprecedented levels as government financing requirements exceeded all other funding sources combined. The bank's note circulation increased from 1.6 billion rubles in 1914 to over 9 billion rubles by 1917, creating inflationary pressures that destroyed the purchasing power stability that had been essential for economic planning and commercial relationships. International financial relationships that Russia had developed with French and British investors created additional pressures as foreign creditors demanded payment, while new lending became increasingly difficult to obtain. The complex web of international obligations that Russian development had required became impossible to service while limiting the government's diplomatic and military options. Industrial finance arrangements that had supported rapid Russian development before the war proved inadequate for wartime mobilization requirements, as banks lacked the institutional capabilities, capital resources necessary for supporting conversion of civilian production to military purposes, while maintaining essential consumer goods production. Agricultural finance systems that had enabled Russia's emergence as a major grain exporter experienced complete breakdown as military mobilization removed rural labor while disrupting transportation and marketing systems. Rural credit cooperatives and agricultural banks proved unable to adapt to wartime conditions while maintaining support for food production. Regional banking disparities throughout the vast Russian Empire created different financial conditions in different areas, while making coordinated financial policy impossible to implement effectively. Some regions experienced complete banking collapse, while others maintained limited services, but overall coordination necessary for national financial planning became impossible. Government economic controls that authorities implemented to address financial crisis included price controls, currency restrictions, and resource allocation policies that interfered with market mechanisms while failing to address underlying problems of excessive government spending and monetary expansion. These controls created additional economic distortions while undermining confidence in government economic management. Inflation acceleration that reached crisis proportions by 1916 destroyed the economic planning and pricing relationships that had supported Russian commercial and industrial development. The combination of unlimited currency creation and wartime resource constraints created price increases that made normal economic relationships impossible to maintain while eroding public confidence in government financial competence. Social welfare finance that had been limited in pre-war Russia proved completely inadequate for addressing the hardships that military mobilization and economic disruption created for ordinary citizens. The absence of effective social support systems created popular discontent that contributed to revolutionary conditions while demonstrating the importance of financial mechanisms for maintaining social stability. International trade finance that had supported Russian exports and imports experienced complete breakdown as currency instability and political uncertainty made normal commercial relationship impossible to maintain. The disruption of international commerce eliminated sources of foreign exchange that had been essential for Russian economic development. banking personnel and institutional capacity proved inadequate for managing the crisis conditions that wartime finance created, as traditional banking skills and experience provided little guidance for addressing unprecedented challenges while maintaining basic financial services under extremely difficult conditions. Revolutionary financial policies implemented by the provisional government in 1917 attempted to address inherited problems through reformed institutions and policies, but these efforts proved inadequate for addressing fundamental economic imbalances, while competing political forces prevented consistent policy implementation. Bolshevik financial policies that followed the October Revolution included repudiation of foreign debts, nationalization of banking institutions, and abolition of private property rights that completed the destruction of traditional Russian financial relationships while creating entirely new economic arrangements based on socialist principles. War debt obligations that Russia had accumulated through foreign borrowing created international political and economic complications that influenced post-war diplomatic relationships while establishing precedents for debt repudiation during revolutionary political changes. The Russian default affected international lending relationships for decades. Industrial banking relationships that had supported Russian economic development were destroyed through nationalization and revolutionary reorganization, eliminating the financial mechanisms that had enabled rapid pre-war growth while creating new institutional arrangements based on central planning rather than market relationships. Currency collapse that accelerated during 1917 and 1918 eliminated the ruble as an effective medium of exchange, while forcing Russian communities to develop alternative payment systems including barter arrangements and local currencies that reflected the complete breakdown of national financial institutions. Economic reconstruction efforts that began under Bolshevik leadership required developing entirely new financial institutions and monetary arrangements that bore no relationship to traditional banking, while serving the requirements of socialist economic planning and political control. The Russian financial collapse demonstrated how military and political pressures could completely destroy sophisticated financial institutions, while showing how economic breakdown could contribute to revolutionary political change. The Russian experience provided warnings about financial sustainability that influenced policy throughout the developed world, while establishing precedents for debt, repudiation and financial system reconstruction that would be repeated during subsequent political upheavals. America's entry into World War I in April 1917 triggered the most dramatic expansion of government finance in the nation's history, as Treasury officials and Federal Reserve authorities developed revolutionary techniques for mobilizing domestic resources while transforming the United States from a creditor nation into the arsenal of democracy through unprecedented financial innovation and institutional expansion. Treasury Secretary William McAdoo's comprehensive approach to war finance combined traditional taxation with revolutionary borrowing techniques that mobilized American savings through mass marketing, campaigns that transformed government bond ownership from an elite preserve into popular patriotic duty. McAdoo's Liberty Bond program became the foundation for modern government securities markets, while demonstrating how financial appeals could serve both economic and political objectives. Federal Reserve System expansion during wartime included fundamental changes in monetary policy and institutional capabilities that abandoned traditional central banking constraints in favor of unlimited credit expansion designed to support government borrowing and industrial mobilization. The Fed's transformation from conservative currency guardian to active economic manager established precedents that would influence American monetary policy throughout the 20th century. Commercial banking adaptation to wartime finance requirements included development of syndicate arrangements for government bond distribution, while expanding industrial lending and maintaining traditional commercial banking services for civilian economic activities. American banks demonstrated remarkable institutional flexibility while developing new capabilities for managing unprecedented transaction volumes and credit relationships. Securities market development that supported massive government borrowing included creating new trading mechanisms, clearing systems, and distribution networks that could handle bond offerings reaching billions of dollars while maintaining market stability and investor confidence. The New York Stock Exchange expanded its operations while pioneering techniques for government securities trading. Industrial finance arrangements that supported rapid military production expansion required new relationships between banks and manufacturing enterprises while enabling technological innovation and production efficiency improvement that made American industry the world's most capable military supplier. Banks developed expertise in project finance while supporting small and medium enterprises contributing to war production. Regional financial mobilization throughout the United States demonstrated how decentralized banking systems could coordinate national objectives while maintaining local economic relationships. Services, rural banks, urban commercial banks, and specialized institutions all contributed to war finance while adapting their operations to serve both national and community requirements. International lending operations that provided financing for allied governments established the United States as the world's dominant creditor while creating financial relationships that would influence international politics and economics for decades. American loans to Britain, France, and other allies reached over $10 billion while establishing institutional capabilities for continued international financial leadership. Government financial administration that managed unprecedented spending levels required developing new institutional capabilities and organizational structures that could maintain accountability, efficiency while handling transaction volumes that exceeded all previous government operations. The Treasury Department expanded its staff and operations while pioneering modern government financial management techniques. Public finance education campaigns that accompanied Liberty bond sales included comprehensive programs for teaching American citizens about government finance, investment principles, and patriotic duty that transformed public understanding of financial relationships while creating lasting changes in American investment behavior and economic attitudes. Corporate finance arrangements that supported business adaptation to wartime conditions included government contracts, loan guarantees, and tax incentives that maintained private enterprise capabilities while ensuring that business activities supported national objectives. These arrangements established precedents for government-business cooperation that would influence American economic policy throughout subsequent decades. Agricultural finance expansion that supported increased food production for domestic and allied requirements included new credit programs, price support mechanisms, and marketing arrangements that demonstrated how financial policies could serve both economic and national security objectives while maintaining agricultural productivity and rural economic stability. Labor finance programs that maintained worker productivity and social stability during military mobilization included payroll savings programs, housing finance, and employee benefits that demonstrated how financial mechanisms could support comprehensive social mobilization while maintaining economic incentives for continued work and production. Technology development financing that supported military innovation and production improvement included government research contracts, patent policies, and industrial development programs that maintained American technological leadership while serving immediate military requirements. These arrangements established foundations for continued government support of technological development. Banking regulation expansion that provided government oversight of wartime financial operations included controls over credit allocation, foreign exchange transactions, and securities trading that demonstrated how emergency conditions could justify comprehensive government involvement in previously private financial relationships while maintaining institutional efficiency. State and local government finance arrangements that supported wartime mobilization included coordination with federal programs while maintaining essential public services and infrastructure development. These arrangements demonstrated how different levels of government could cooperate in financial mobilization while preserving federal institutional relationships. Insurance market expansion that addressed wartime risks and social needs included new products for military families, industrial operations, and international activities that demonstrated how insurance could serve both private and public policy objectives while maintaining institutional profitability and stability. International trade finance arrangements that supported Allied purchasing and American export expansion required developing new techniques for managing payment risks, currency fluctuations, and transportation difficulties while maintaining commercial relationships despite military disruptions to normal international commerce. Resource mobilization techniques that converted private savings into public resources included innovative taxation, voluntary savings programs, and public-private partnerships that maintained property rights and economic incentives, while ensuring that national resources were available for military purposes. These techniques influenced government finance policy throughout the developed world. By late 1918, American financial institutions had demonstrated remarkable capabilities for economic mobilization while establishing institutional precedents and technical innovations that would influence government finance, monetary policy, and international economic relationships throughout the remainder of the 20th century, confirming America's emergence as the world's dominant financial power. Victory bonds, the development of mass government bond marketing during World War I, represented one of the most significant innovations in public finance history, as authorities in every major belligerent nation discovered how to mobilize ordinary citizens' savings for government purposes while creating lasting changes in investment behavior and the relationship between individuals and government financial operations. The British National War Bonds program pioneered techniques for selling government securities to working-class and middle-class investors who had never previously owned government bonds, using installment payment plans, small denominations, and workplace distribution systems that made government securities accessible to ordinary income earners. These innovations transformed government borrowing from an elite financial activity into popular patriotic participation. American Liberty Bonds represented the most successful mass government security distribution program in history, as Treasury Secretary William McAdoo's marketing campaigns combined patriotic appeals with sophisticated sales techniques that mobilized over 20 million individual purchasers while raising over $17 billion through 4 separate bond issues between 1917 and 1919. German war loan campaigns demonstrated how authoritarian governments could achieve remarkable success in mobilizing domestic savings through comprehensive propaganda campaigns and social pressure that made government bond purchase a measure of patriotic duty, while providing attractive investment returns that competed effectively with private sector alternatives. French defense bonds marketing included innovative techniques for reaching rural populations and small savers who had traditionally kept their wealth in bank deposits or gold hoarding, using networks of local banks, post offices, and community organizations to make government securities available throughout the country, while educating citizens about investment principles. Marketing techniques developed for government bond sales included advertising campaigns, celebrity endorsements, workplace presentations, and door-to-door sales efforts that pioneered modern mass marketing, while demonstrating how emotional appeals could be combined with financial incentives to achieve unprecedented sales volumes and geographic distribution. Distribution systems that enabled mass government bond sales required developing new institutional arrangements that could handle millions of individual transactions while maintaining record-keeping, accuracy, and providing customer services that had never been necessary for traditional government borrowing from wealthy investors and institutions. Installment payment plans that made government bonds accessible to ordinary income earners represented financial innovations that enabled people with limited cash reserves to purchase securities through payroll deductions and monthly payment arrangements, creating precedents for consumer finance that would influence American financial markets throughout the 20th century. Workplace distribution programs that enabled government bond sales through employer partnerships included payroll deduction plans, workplace presentations, and peer pressure campaigns that achieved remarkable participation rates, while demonstrating how employment relationships could serve government finance objectives and patriotic mobilization. Educational campaigns that accompanied government bond marketing included comprehensive programs for teaching citizens about investment principles, government finance, and economic relationships that transformed public understanding of financial markets while creating lasting changes in American investment behavior and attitudes toward government securities. Celebrity endorsements and propaganda techniques that supported government bond marketing included participation by movie stars, athletes, and other public figures in sales campaigns that demonstrated how popular culture could serve government finance objectives, while pioneering techniques for celebrity marketing that would become standard practices in American advertising. Community organization and social pressure techniques that supported government bond sales included neighborhood committees, social group competitions, and public recognition programs that made bond purchase a measure of community participation and patriotic duty, while demonstrating how social relationships could serve government policy objectives. Pricing and yield strategies that made government bonds attractive to ordinary investors included offering competitive interest rates, tax advantages, and payment terms that provided superior returns compared to bank deposits and other traditional savings vehicles, while maintaining affordability for middle-class and working-class purchasers. Record-keeping and administrative systems that enabled mass government bond distribution required developing new organizational capabilities that could manage millions of individual accounts while providing customer services including payment processing, redemption procedures, and investor communications that maintained public confidence and satisfaction. International coordination of government bond marketing included sharing techniques and strategies between allied governments while adapting programs to different national cultures and political systems, demonstrating how financial innovations could be transferred across national boundaries while serving common objectives. Long-term consequences of mass government bond ownership included creating constituencies for government financial management while establishing precedents for public participation in government finance that would influence tax policy, monetary policy, and political relationships between citizens and government throughout the remainder of the 20th century. Financial market development that resulted from government bond marketing innovations included expansion of securities trading, investment services, and financial education that created lasting changes in American capital markets while establishing institutional capabilities that would support continued market growth and sophistication. Social and cultural changes that accompanied mass government bond ownership included altered attitudes toward investment, government finance, and individual financial responsibility that reflected broader changes in American society, while demonstrating how financial relationships could serve social policy objectives and national unity. Regional variations in government bond marketing success reflected different economic conditions, cultural attitudes, and institutional capabilities throughout the various countries, while demonstrating how financial programs needed to be adapted to local conditions while serving national objectives and maintaining political support. Corporate participation in government bond marketing included employer-sponsored programs, business community leadership, and corporate advertising that demonstrated how private enterprise could serve public objectives while maintaining business relationships and commercial activities during wartime mobilization. Gender and demographic aspects of government bond marketing included specific appeals to women, ethnic groups, and different occupational categories that pioneered demographic marketing techniques while demonstrating how financial appeals could address different social groups' interests and motivations. Economic consequences of successful government bond marketing included mobilization of previously untapped savings sources while creating new relationships between government finance and private savings that would influence fiscal policy and monetary relationships throughout the modern era of expanded government economic responsibilities. Post-war continuation of government bond ownership established lasting constituencies for government securities markets, while creating institutional capabilities and public attitudes that would enable continued government borrowing for economic management and social programs throughout the remainder of the 20th century. Inflation crisis. The inflationary consequences of unlimited war finance created economic disruption throughout the belligerent nations, as governments discovered that abandoning monetary discipline enabled unprecedented resource mobilization, while destroying the price stability and economic predictability that had supported pre-war commercial relationships and social stability. Monetary expansion that accompanied government borrowing created currency depreciation and price increases that accelerated throughout the war period, as authorities chose continued military spending over monetary stability, demonstrating how political pressures could override economic constraints while creating long-term consequences that would influence post-war economic development. Price control efforts that governments implemented to manage inflation included comprehensive regulations covering essential commodities, labor markets, and commercial relationships, but these administrative measures proved unable to address fundamental imbalances between unlimited government spending and limited real resources, while creating black markets and economic distortions. International currency relationships that had provided stability under gold standard arrangements experienced severe disruption as competitive devaluation and exchange controls replaced automatic adjustment mechanisms, creating uncertainty and risk that complicated international trade and investment while contributing to post-war economic nationalism. Social consequences of inflation included erosion of fixed incomes, disruption of savings and retirement planning, and redistribution of wealth from creditors to debtors that created political tensions and social instability, while demonstrating how monetary policies could serve as mechanisms for involuntary wealth transfer between different social groups. German hyperinflation that developed during the early 1920s provided the most extreme example of how unlimited government borrowing and monetary expansion could completely destroy currency stability and economic relationships, creating social chaos and political instability that contributed to the rise of extremist political movements and the breakdown of democratic institutions. British inflation management that maintained relative currency stability despite massive government borrowing demonstrated how sophisticated monetary policy and international cooperation could limit inflationary pressures while enabling continued war finance. But even British success came at the cost of abandoning gold standard discipline that had been fundamental to pre-war monetary arrangements. American inflation that accelerated during 1917 and 1918 reflected both domestic war spending and international capital flows, as European allies purchased American goods with borrowed dollars, creating price pressures that Federal Reserve authorities attempted to manage through interest rate policies and credit controls that established precedents for modern monetary management. French inflation that reached crisis proportions during the final war years demonstrated how countries with limited fiscal capabilities and substantial war damage could experience severe monetary instability despite sophisticated financial management, creating economic hardships that contributed to post-war political and social tensions. Labor market disruptions caused by inflation included demands for wage increases that could keep pace with rising prices, while employers faced cost pressures that threatened profitability, production capacity, creating industrial relations conflicts that required government intervention and mediation while establishing precedents for wage indexation and labor market regulation. Agricultural price volatility that accompanied general inflation included dramatic increases in food costs that created social hardships while providing windfall profits for farmers who could take advantage of increased demand, demonstrating how inflation created winners and losers while disrupting traditional economic relationships and social structures. International trade complications that resulted from currency instability and inflation included difficulties in pricing long-term contracts, managing exchange rate risks, and maintaining commercial relationships when monetary values were changing rapidly, forcing businesses to develop new techniques for international commerce while creating barriers to trade expansion. Government finance management that attempted to address inflationary pressures included efforts to increase taxation, reduce non-military spending, and coordinate monetary policy with fiscal objectives, but these measures proved inadequate for addressing fundamental imbalances, while political pressures prevented implementation of policies that might have reduced inflation at the cost of military effectiveness. Central bank policy responses to inflation included attempts to manage money supply growth, coordinate international monetary policies, and maintain confidence in domestic currencies, but these efforts were constrained by government borrowing requirements that made traditional monetary discipline impossible, while establishing precedents for central bank subordination to fiscal authorities. Business adaptation to inflationary conditions included development of new accounting methods, pricing strategies, and inventory management techniques that enabled companies to maintain operations while protecting against currency depreciation and cost increases, pioneering business practices that would become standard during subsequent inflationary periods. Consumer behavior changes that resulted from inflation included altered saving and spending patterns as people learned to protect their wealth against currency depreciation while adjusting consumption patterns to account for changing relative prices, creating social and cultural changes that would influence economic relationships throughout the post-war period. International coordination efforts that attempted to address inflation through cooperative policies included allied financial coordination and currency stabilization arrangements, but these efforts proved insufficient for addressing fundamental problems while establishing precedents for international economic cooperation that would influence post-war monetary reconstruction. Regional variations in inflationary impact reflected different economic conditions, government policies, and social structures throughout the various countries, while demonstrating how national policies could have different consequences in different areas and for different social groups, creating political pressures for differential policy responses. Measurement and statistical development that improved understanding of inflation included creation of price indices, cost of living studies, and economic analysis that provided better information for policymaking, while establishing institutional capabilities for economic monitoring that would support more sophisticated economic management during subsequent periods. Long-term consequences of wartime inflation included altered expectations about price stability, changed attitudes toward government economic management, and institutional precedents for monetary expansion that would influence economic policy throughout the remainder of the 20th century, while creating political constituencies for continued government economic intervention. Post-war deflation that followed inflationary expansion created additional economic disruption as authorities attempted to restore price stability and currency credibility through contractionary policies that imposed severe economic hardships while demonstrating the difficulties of reversing inflationary policies once they had become embedded in economic relationships and political expectations. Post-war reckoning. The financial aftermath of World War I created unprecedented challenges for international economic reconstruction as governments attempted to restore monetary stability and fiscal responsibility while managing enormous debt burdens, currency instability, and the complex web of inter-allied financial obligations that war finance had created. German reparations obligations that were established by the Treaty of Versailles created additional international financial complications as the defeated power was required to make payments that exceeded its economic capabilities while maintaining domestic political stability, creating tensions between international obligations and domestic economic requirements that would contribute to political instability throughout the 1920s and 1930s. Currency stabilization efforts that followed the war's end included attempts to restore gold standard relationships and exchange rate stability, but these efforts proved difficult to achieve given the enormous changes in relative national economic positions and the political pressures for continued expansionary policies that war finance had created throughout the belligerent nations. Debt reconstruction and refinancing that became necessary after the war included comprehensive reorganization of government obligations while attempting to restore investor confidence in public finance and monetary management, requiring sophisticated negotiations between creditors and debtors while establishing precedents for international debt management and restructuring. Banking system reconstruction that addressed war-related institutional changes included efforts to restore conservative lending practices and monetary discipline while maintaining the expanded capabilities and public responsibilities that war finance had created, requiring careful balance between financial stability and continued government economic involvement. International monetary cooperation that developed during the post-war period included efforts to coordinate currency policies and restore international financial stability through institutional arrangements that could address the changed conditions while maintaining national sovereignty over domestic economic policy, establishing precedents for subsequent international monetary arrangements. Inflation management and monetary stabilization that became necessary after wartime expansion required developing new techniques for controlling price levels and currency values while maintaining economic activity and employment, demonstrating how monetary policy had become more complex and politically sensitive than traditional gold standard operations had required. Fiscal policy reconstruction that addressed wartime spending expansion included efforts to restore balanced budgets and reduce government debt burdens while maintaining expanded public services, social welfare programs that war mobilization had established, creating lasting tensions between fiscal responsibility and political demands for continued government economic intervention. Financial market development that built upon wartime innovations included continued expansion of government securities markets, corporate finance capabilities, and mass investment participation while adapting to peacetime economic conditions and regulatory requirements that addressed problems identified during wartime financial operations. International trade finance reconstruction that restored commercial relationships disrupted by war included developing new payment systems, currency arrangements, and credit facilities that could support expanded international commerce while managing the risks and uncertainties that continued political tensions and economic instability created. Regional economic reconstruction that addressed war damage and industrial conversion included financial arrangements for rebuilding destroyed infrastructure while converting military production capacity to civilian purposes, requiring coordination between public and private finance while maintaining employment and economic stability during transition periods. Social welfare finance that addressed war-related social needs included pension programs for veterans and war widows, unemployment assistance for demobilized military personnel, and healthcare programs for war-related injuries and disabilities, establishing precedents for comprehensive social welfare systems that would expand throughout the 20th century. Corporate finance reconstruction that addressed wartime industrial changes included reorganization of enterprises that had expanded during war production while adapting to peacetime markets, competition, requiring new approaches to business finance while managing the transition from government contracts to private market relationships. Labor market finance that addressed demobilization and industrial conversion included programs for veteran employment, worker retraining, and industrial relations that could maintain social stability while adapting to changed economic conditions and altered relationships between government, business, and labor organizations. Technology transfer and innovation finance that addressed wartime technological development included arrangements for converting military innovations to civilian applications while maintaining continued research and development capabilities that could support long-term economic competitiveness and industrial development. Insurance market reconstruction that addressed war-related changes in risk management included development of new products and institutional arrangements that could serve expanded social welfare functions while maintaining private sector efficiency and innovation in risk assessment and management. Educational and cultural finance that supported post-war social reconstruction included programs for veteran education, adult retraining, and cultural development that demonstrated how financial mechanisms could serve broad social objectives while maintaining individual opportunity and social mobility. Agricultural finance reconstruction that addressed wartime production changes included programs for converting expanded agricultural capacity to peacetime markets while maintaining rural economic stability and food security, requiring coordination between price support mechanisms and international trade policy. International investment and development finance that addressed reconstruction needs included arrangements for mobilizing capital for European reconstruction while maintaining investor protections and economic incentives that could support long-term development and political stability, establishing precedents for international development assistance and investment protection. Constitutional and legal changes that addressed expanded government economic responsibilities included recognition of enhanced federal authority over economic affairs while maintaining traditional limitations on government power, creating lasting tensions between economic efficiency and constitutional constraints that would influence policy debates throughout subsequent decades. The comprehensive nature of post-war financial reconstruction demonstrated how wartime innovations in government finance and monetary policy had created permanent changes in economic institutions, political relationships that could not be simply reversed through return to pre-war arrangements, establishing foundations for modern mixed economy systems that would characterize developed nations throughout the remainder of the 20th century. Financial legacy. The institutional and policy innovations that emerged from World War I financing created the foundation for modern government economic management, establishing precedents and capabilities that would influence fiscal policy, monetary operations, and financial market development throughout the remainder of the 20th century, while fundamentally altering the relationship between government and private finance. Central banking transformation that occurred during the war established precedents for active monetary policy and government economic management that went far beyond the traditional role of maintaining gold convertibility and providing emergency liquidity, creating institutional capabilities for economic stabilization and policy coordination that would become standard central bank functions during subsequent decades. Government borrowing techniques that were pioneered during wartime finance included mass marketing of government securities, institutional coordination of bond distribution, and public education, campaigns that transformed government debt markets from elite financial preserve to popular investment opportunity, while establishing the foundation for modern public debt management. Securities market development that resulted from wartime innovations included expanded trading capabilities, improved clearing and settlement systems, and institutional arrangements for government bond distribution that established the infrastructure necessary for continued capital market growth, while enabling government access to private savings for policy implementation. International financial relationships that emerged from wartime lending and currency cooperation included precedents for policy coordination, debt management, and monetary stabilization that would influence international economic institutions throughout subsequent decades, while establishing the United States as the dominant international creditor and financial leader. Monetary policy innovations that replaced gold standard constraints included techniques for managing interest rates, controlling credit expansion, and coordinating fiscal and monetary policies that enabled active government economic management while creating tools for addressing economic instability and unemployment that had been unavailable under traditional monetary arrangements. Banking regulation expansion that resulted from wartime government involvement in financial operations established precedents for comprehensive oversight and policy coordination that would be expanded during subsequent crises, while demonstrating how government authority over financial institutions could serve broad economic and social policy objectives. Fiscal policy capabilities that were developed during wartime mobilization included taxation innovations, spending program management, and debt administration that enabled permanent expansion of government economic responsibilities, while establishing institutional capabilities for social welfare provision and economic stabilization that would characterize modern democratic governments. Corporate finance evolution that resulted from wartime government-business cooperation included precedents for public-private partnerships, government-industrial policy, and mixed economy arrangements that would influence business organization and industrial development throughout the remainder of the 20th century. Financial innovation techniques that were pioneered during wartime finance included structured instruments, syndicate arrangements, and mass marketing methods that established foundations for continued financial market development, while creating institutional capabilities that would support expanded government economic activities and private sector growth. International economic cooperation arrangements that emerged from wartime financial coordination included precedents for policy consultation, institutional cooperation, and crisis management that would influence the development of international economic organizations while establishing frameworks for managing interdependent national economies. Social welfare finance mechanisms that were established during wartime mobilization included precedents for government provision of social insurance, veteran benefits, and employment assistance that would be expanded into comprehensive welfare state systems, while demonstrating how financial arrangements could serve broad social policy objectives. Economic measurement and analysis capabilities that were developed for wartime economic management included statistical systems, forecasting techniques, and policy evaluation methods that would support more sophisticated economic planning and policy implementation, while enabling better understanding of complex economic relationships. Educational and cultural finance innovations that supported wartime mobilization included precedents for government investment in human capital development, research and development, and cultural institutions that would influence social policy throughout subsequent decades, while demonstrating how financial mechanisms could serve broad societal objectives. Regional development finance that addressed wartime economic changes included precedents for government investment in infrastructure, industrial development, and rural economic support that would influence regional policy, while establishing frameworks for addressing geographic inequalities and promoting balanced economic development. Labor market finance arrangements that were developed during wartime mobilization included precedents for unemployment insurance, job training programs, and industrial relations support that would influence labor policy while demonstrating how financial mechanisms could serve employment objectives and social stability. Technology development finance that supported wartime innovation included precedents for government research support, patent policy, and technology transfer that would influence science and technology policy while establishing frameworks for promoting continued innovation and industrial competitiveness. Insurance market development that addressed wartime social needs included precedents for government involvement in risk management, social insurance provision, and private-public cooperation that would influence insurance regulation while demonstrating how insurance could serve broad social policy objectives beyond private risk transfer. International trade finance innovations that supported wartime commerce included precedents for government export promotion, trade financing assistance, and commercial diplomacy that would influence trade policy while establishing frameworks for promoting international commercial relationships and economic development. Constitutional and legal precedents that emerged from wartime government economic expansion included recognition of enhanced federal authority over economic affairs while establishing frameworks for government economic intervention that would influence constitutional interpretation and political relationships throughout subsequent decades. The comprehensive transformation of financial institutions and economic policy that resulted from World War I financing requirements established the foundation for modern mixed economy systems that combine private enterprise with active government economic management, creating institutional capabilities and policy precedents that would enable governments to address subsequent economic challenges while maintaining democratic political systems and private property rights. These innovations demonstrated both the potential and the risks of expanded government economic involvement, while establishing institutional frameworks and policy tools that would be essential for managing the complex economic challenges of industrialized democratic societies throughout the remainder of the 20th century and beyond. The transformation of global banking systems during World War I represents one of the most profound institutional changes in economic history, fundamentally altering the relationship between government and finance, while establishing the foundation for modern economic management that continues to shape our world today. The conservative banking practices and limited government financial involvement that had characterized the pre-war era were replaced by revolutionary techniques for monetary expansion and resource mobilization that enabled unprecedented government spending while permanently changing how money, credit, and public finance operate. The scale of this transformation cannot be overstated. In 4 years, governments increased their spending by 10-20 times pre-war levels, while creating entirely new financial instruments and institutional arrangements that mobilized resources on a scale previously unimaginable. The techniques developed for selling government bonds to ordinary citizens, creating unlimited central bank credit, and coordinating fiscal and monetary policies established precedents that would influence government economic capabilities throughout the remainder of the 20th century. Perhaps most significantly, the war demonstrated that traditional constraints on government spending and monetary expansion could be abandoned when political necessities required, establishing the principle that economic limitations were matters of choice rather than immutable physical laws. The gold standard constraints that had imposed automatic discipline on fiscal and monetary policy were replaced by discretionary management that enabled governments to pursue economic and social objectives that had been impossible under previous institutional arrangements. The banking innovations that emerged from wartime necessity created the foundation for modern financial markets and government economic management. Mass marketing of government securities transformed millions of ordinary citizens into investors, while establishing the infrastructure necessary for democratic participation in government finance. Central bank money creation replaced gold standard discipline with active monetary policy that could address unemployment and economic instability through credit expansion and interest rate management. The international consequences of wartime financial innovations established the United States as the world's dominant financial power while creating new forms of international economic interdependence and cooperation. The inter-allied debt relationships and currency stabilization efforts that emerged from war finance provided models for international economic institutions while demonstrating how financial relationships could serve diplomatic and strategic objectives. However, the abandonment of traditional financial discipline also created new forms of economic instability and social tension. The inflation that accompanied unlimited monetary expansion redistributed wealth between different social groups, while creating expectations for continued government economic intervention that would influence political development throughout democratic societies. The debt burdens that governments accumulated during the war constrained post-war policy choices while establishing precedents for deficit spending that would become permanent features of government in operations. The regional and national variations in wartime financial innovation demonstrated how different institutional structures and political systems could adapt to similar challenges different ways while achieving broadly similar outcomes. The German universal banking model, British merchant banking traditions, American Federal Reserve System, and French centralized approach all evolved to serve wartime requirements while maintaining their distinctive characteristics and capabilities. The human dimensions of financial transformation during the war included fundamental changes in individual economic relationships and social structures. Millions of people who had never owned securities became government bondholders, while traditional saving and investment patterns were altered by inflation and new financial instruments. The expansion of government economic responsibilities created new forms of social welfare and economic security, while altering the relationship between individual economic welfare and political institutions. Looking at the long-term consequences, the financial innovations of World War I provided the institutional foundation for every major economic policy development of the subsequent century. The New Deal programs of the 1930s, the Keynesian economic management of the post-war period, the welfare state expansion of the 1960s, and the monetary activism of recent decades all built upon institutional capabilities and precedents that were established during wartime financial mobilization. The global nature of these changes created lasting alterations in international economic relationships, while establishing patterns of cooperation and competition that would influence economic diplomacy throughout the modern era. The techniques developed for international financial coordination during the war provided models for managing increasingly complex and interdependent national economies while addressing common challenges and objectives. Whether we evaluate these changes as beneficial or harmful depends largely on our assessment of the trade-offs between economic efficiency and political autonomy, individual freedom and social welfare, financial stability and economic flexibility. The wartime financial innovations enabled governments to address social problems and economic challenges that market mechanisms had been unable to resolve, while also creating new forms of economic instability and political pressure that continue to influence contemporary policy debates. Understanding how modern financial institutions and economic policies emerged from the crucible of World War I provides essential context for evaluating contemporary economic challenges and policy alternatives. The institutional capabilities and precedents established during wartime continue to shape how governments respond to economic crises while influencing the relationship between private enterprise and public authority in democratic societies. The banking system that financed World War I ultimately financed not just a military conflict, but the transformation of industrial society itself, creating the institutional foundations for modern economic life, while establishing the precedents and capabilities that continue to influence how governments, businesses, and individuals navigate the complex economic relationships of the contemporary world.